I'm fairly talkative nowadays, like yourself, Vinney.
Nobody can stop me. I know my wife says, Kanchan says, come on, you got to conserve your energy. I'm so excited.
Jessica tells me the same thing all the time. She goes, you tell us when we walk into a party or something like that, we're going to be there for 30 minutes. She goes, I already know we're going to be here for 3 hours because you're just going to talk to everybody and you won't stop. You won't stop talking. Yeah, definitely. So I didn't get into sales. I almost got into real estate sales, but I said, you know what? I was kind of shy. I was kind of quiet. I didn't feel it at the time. And so I had heard about appraising. I met somebody who was an appraiser and he needed a staff appraiser. So we kind of just moved through it and he trained me and I became an appraiser. And then 2 years after that, I went out and started my own appraisal company. And I still have that company to this day. Mm-hmm. And it's not the biggest, fattest money maker, but it's consistent. Yeah. It's pretty passive. It's like 95% passive for me right now. So I don't work in it day to day all the time, you know, literally 15 minutes here, maybe an hour there a day. And it's mostly passive. But that was a great business for me. And I learned a lot about real estate because you analyze a lot of real estate. So now to this day, we've done over 100,000 appraisals and about 50 to 75,000 appraisals I've done myself. I've done, work for them. And so it's really nuts to think that those numbers, but when I started crunching the numbers one day, because I was just curious, I was like, man, I can't believe I analyzed that many deals, looked at that many deals. And so it's helped out so much from what I just said, the analyzing side of it. So from flipping and all that other sort of stuff. But the way that I kind of moved into flipping was I actually got picked up by one of the biggest flippers in California. They asked me to come over there and actually just sit down at the round table with them and help them figure out why certain houses weren't selling and why they're selling below what they were hoping for. They were a big flipper. So when I say like the round table, like they sat me in a conference room with like 30 people.
Oh my gosh. Wow.
Yeah, and they had a big screen and I had to analyze deals real time for them.
Oh, wow.
And so, this kind of goes to what I've learned from my mentors. You got a guy like Tony Robbins, for instance. When he said where he learned how to speak, he said where other speakers were picking up a speaking engagement here and there, doing one a week, he said, I did 4 a day. Mm-hmm. I took massive action and I just went out there and I was scared and everything else, but I just went through it and you fail fast. Yeah. And so when this big flipper, I was very intimidated to sit in front of all these people and analyze these deals real time and tell people what they did wrong. Yeah. I mean, these are professional people. They're very, very, very smart, very wealthy people. But I tell you what, I really appreciate that I did it because again, I learned really quick and I learned a lot. And so that kind of helped me to see what was going on the flipping back end. And then just seeing so many other people doing it, I said to myself, man, if they can do it, I can do it. With my construction background and my real estate background, I can most definitely do it. So in 2009, I started flipping just a little bit here and there. First deal that I flipped, lost $75,000 on. That was a lovely lesson. And the money I lost was not even my money. It was my uncle's money.
Oh, wow.
But I spent the next 3 years paying him back. Yeah. And I paid him back. And then I paid him back in full. But that was my college education right there, right? Yeah. We all pay in different ways.
Totally.
I paid it like that. So
and you've done lots of flips. I know you and I and did a flip. We made good money in Rossmore.
Yeah, that's right. Yeah. That was a really fun time doing that with you. And you got to see,
I want to do more. I'm saying it publicly right now.
Let's do it.
I have this much money and I'd love to do it,
Yeah. You mean this much money?
But again, thank you guys. I hope you're listening. You're enjoying this content from Mario and me. And we're going to dig deeper into the freedom and also the real estate, the advantages of real estate. We're going to talk about also the biggest thing I hope you get out of it is, are you in real estate or not? If you're on the tiptoeing, on the other side, this is the right time. 2022 is upon us. It's going to be great. There will be many opportunities. And I have a $50 million fund right now 506C fund for accredited investors only. And I can talk to you, see, because I can advertise, I can talk, and I'm just closed the deal. I'll say that little blurb, if it's okay, Mario. I just bought a deal for $12.5 million, and I can discuss it on the show today from Knoxville, Tennessee. And the seller had put almost $4 million already, renovating all the interiors, all brand new appliances, all brand new roofs, and air conditioning, you name it. But she did not increase the rents because she was a flipper in multifamily. And John brought it on. We closed on the deal end of October 2021 for $12.5 million. We have increased the rent by $300. As soon as we picked up in November, we increased the rent by $300. In January, February, we're going to increase $300 more. What? The difference between the price right now and what is in the market next door, it's almost $1,000 difference per month, Mario. Wow. So this $12.5 million will be worth $15.5 million. Believe me. Anybody who is listening to me, you could reach me back again in 2 years. It'll be that. And we also started the RUB system. I'm just kind of giving a little promotion. I'm going to come back to you, Mario. I just got it going.
I love listening.
But the thing is, the RUB, the internet, the cable, the water, the trash, the sewer, the seller was charging zero money. So we are collecting $81 per month on that one also. And nobody's leaving. It's 97% occupied, wow. And we just bought it. Anyway. But I just wanted to say that, the flipping business is great. The multifamily business is great. And Mario is going to talk about, let's come back to our show again, Mario.
But multifamily, that's ultimately where it's at. Flipping is good. It's just a stepping stone. Like, you shouldn't do it forever. It's a means to make money, to take that money and reinvest that money. And
totally.
Invest it in multifamily, 100%, because it's that passive income. That's what's going to set you free.
That's it.
The passive. When you go on vacation for a week and you made money while you're on vacation.
So true. When you're sleeping at night, you're making money because residents are paying the mortgage. They are paying the mortgage balance, we call it. So they're reducing the loan. So that is a big thing. Leverage, right, Mario? I mean, if the investors are putting 100,000, but guess what? That 100,000 is only paying 30% down. But in effect, they are buying a deal 3 times that much. So if somebody gives me 100,000, actually their position is at 300,000. Because of the leverage, right? That's at 66% loan, but at 70 or 80% leverage, they are even worth their 100,000. They're having a position of ownership at 4 times that. 4 times that, which is almost like 400,000, which cannot be done in stock market.
I was just going to say that.
Expand on it.
What does Robert Kiyosaki say about this? When's the last time the bank gave you a loan to buy a stock? But when's the last time the bank gave somebody a loan to buy a stock or buy real estate? Yes. They give loans all the time to buy real estate. We don't ever get a loan from the bank. You can't go to Bank of America and say, I want to buy the S&P 500. They're going to say, go ahead, use your own money. We're not giving you a penny. But the bank, if you were buying as your primary residence, they will give you 96.5% down.
Right.
And if you're a veteran, they'll give you 100% down.
100% down. Yeah.
Zero money out of your own pocket.
It's so smart. I mean, it's so thinkful.
Leverage.
Everybody should really look into that, guys, listening or watching us. If you're not really leveraging your money, you're getting 0.015% per year from your local bank, or 2% or 3%, or even in the stock market, 7.06%. I saw, there's some statistic over 20 years. Of course, this year has been pretty good year. We just still don't know. Market is kind of down. But anyway, the key thing is leverage. Then real estate we talked about, right? We talked about, how about tax ramifications? Can you expand on that?
Oh man, I mean, when you become a real estate professional, your accountant will say, hey, you became a real estate professional today because you do enough real estate. And all of a sudden now you can take all these extra deductions that you weren't allowed to take before. So that's one thing. Now, there are some high taxes, like flipping is high tax. That's for sure. Short-term capital gains, 100%. But that's the lovely thing about passive, right? So when you have passive, you explain what's like the number one thing that you give to your investors. I'm one of your investors, so I know. But what's one of the things that you give to your investors when you invest in multifamily real estate? What are the big tax benefits that you can get from that?
Totally. Mario, as you recall, I mean, we are, a big syndication company, right? That's where Monil Investment Group, Monil Senior Living now, and then Ideal Investment Group. So 3 companies I've owned. And now I'm into assisted living and senior assisted living and memory care developments, and then buying them after I build them, cashing out investors at 18 to 20% per year quickly. And then having them again get into another system with me for next 5 years, right? But you're right. We do cost segregation. Right. What is cost segregation? It's just like the word says, it takes the depreciation, which is straight line. We could take it, or we could segregate it. We could find out what part of the building can be written off in 1 year, what part of the portion of the building can be written off in 5 years, and some in 10 years, some in 15 years, and the rest will be 27.5 years. Right. So by having this millions of dollars in depreciation, the year we buy it, the LLC that owns the asset is a pass-through entity. So we never pay taxes at the LLC level, but we give the total P&L, profit and loss, we call it, at all the revenues coming in, rents and everything, other incomes, minus all the expenses and the mortgage and everything, it's making profit. We call it cash flow. So the cash flow is strong, but when the CPA takes our profit and loss statement for 2021, they also put something depreciation. Now, everything is positive, right, Mario? But depreciation of $3 million. We are going to get that $3 million loss at the Adelaide property this year. So my investors who gave me $500,000, they might get minus $200,000 in the K1 net income loss in the second box of minus $200,000. So it just makes so much sense to really, really invest in real estate. If you're a passive investor also, you had other incomes come in passively, you could take this minus 200,000 and then you don't have to pay taxes.
That's right.
Right? You want to kind of expand? Yeah.
Yeah, I was just going to add a few things because some people may not understand the reason that you're able to depreciate is because just like everything in life, it ages. And so the life expectancy roughly of real estate is roughly around 35 years, 30 to 35 years.
Yep.
And so what they're allowing you to do when you're doing that is they're saying, okay, your plumbing, your electrical, all these things, it's aging. And you're able to speed that up and take it over, instead of over a 30-year period, you can take it over a 5-year period and so on and so forth. So you speed it up, rapid depreciation. But that's also why you don't hold property for 30 years. You turn it over so you can continue to depreciate each individual property. So the thing I'm going to add to this is that, there's this quote of the rich continue to get richer, right? Yeah. And you and I both started off our lives not rich, not even a dollar in our pocket, pretty much, right?
Yep.
And a lot of people we know are the same. And so, but with the people that we learn from, what do? They surrounded themselves around other successful people. And what you do as a syndicator is you have an organization where somebody that is not extremely wealthy yet, but is on their way to getting there. Now they can join this club. Yeah. And they can take part of all the wealth building tools that you provide, cost segregation and all these other things. And your expertise, your analysis of the market areas, you only invest in a few market areas every year because you analyze really, really deeply. And so I get a lot of people ask me, should I go out and buy my own duplex or should I invest with a syndicator or something like that? And I always say, well, if you're going to invest with a syndicator, they're not all, equal. They're not all the same. There's plenty of people who call themselves syndicators. But I'd go with somebody like Vinney, who has a wonderful track record. And you just look at your track record. Look how long you've done it for. Look at what you've done, right?
36 syndications, going strong, 700 million almost now, Oh my gosh.
Yeah. And so you pull your money together with somebody like Vinney, and and then in the process, learn what you're doing too, and take part of the learning, and it's amazing. And then when you get that negative K1 at the end of the year, but you had cash flow, you're going to say, wow, I did not realize the power of that. But you could have taken that same amount of money and went and bought a new car with it.
Yeah.
And that car is going to go down in value as soon as you drive it off the lot. It's going to make you feel cool. You're going to feel your ego is going to inflate, like all these things, right?
Yeah.
It's like if you were trying to get some energy, it's like eating healthy or eating a bunch of sugary food. That's buying the fancy cars, like eating the sugary food. You get the jolt, but it dissipates. You invest in something that's passive, like with you, and it may not give you that same immediate rush of like driving off the lot with a new car, but you give it a little bit of time and it's going to be sustained, and it's going to do the exact opposite of the car. The car is going to go this way, and the investment's going to go that way.
Go that way. So
and when they get paid back, they can take it and do it again. And, I'm going to add, just research wealthy people, research the rich. Not one rich or wealthy person has ever made sustained wealth off of the money that they generated. It's the money they generated put into an investment. Warren Buffett, what does he do? He invests.
Yeah.
He is, and that's all he does is invest.
Yeah.
Literally, that's all he does.